Good morning, good afternoon, everyone, and thank you very much for joining today's Quantitative Disclosure Summary presentation. I am Kawai in JSCC Clearing Planning Department, and I will be leading today's session. Today's webinar will take about 30 minutes. We will start with an overview of the Q1 2026 Quantitative Disclosures, then move on to this quarter's key topics, followed by key risk indicators, and finally a Q&A. All participants are muted. Please use the Q&A function to submit your questions. With that, let's get started. Let me begin with the highlights for this quarter. JSCC keeps 75 billion yen of skin in the game, mostly from JSCC's own capital, but it also includes contributions from affiliated exchanges. On aggregate, these were equal to 71% of JSCC's shareholder equity. During this quarter, stress test breaches, where the risk amount in extreme but plausible market conditions exceeded pre-funded resources, were observed on 6 days for the cash securities clearing services and 1 day for the ETP Energy Token clearing service. All of the breaches were resolved on the next business day through the requirement for additional collateral. As for margin backtesting for the past 12 months, the cover ratios were below JSCC's targets in ETP Index Future and Option OSE, ETP Precious Metals OSE, and IRS. As a result, we revised the stress test scenario for IRS in May 2025. JSCC's risk appetite is set at 99.5% for IRS and CDS and 99% for other products. There were neither liquidity stress testing breaches nor any participant defaults during this quarter. JSCC experienced no suspension of the clearing service due to system failures or for any other reasons during the past 12 months period. Now, let me move on to the first topic, market volatility. During this period, we observed significant market volatility, particularly in equities, gold, and crude oil. In the equity market, prices initially increased following Japan's lower house election on February 8th, reflecting improved market sentiment. However, from late February onward, prices declined due to the deterioration of geopolitical conditions in the Middle East. Gold prices were also highly volatile, driven in part by the announcement of the next Federal Reserve chair. Notably, gold recorded a sharp decline of 15% on February 2nd, followed by a rebound of 10.8% the next day. Similarly, Dubai crude oil saw a significant upward movement amid escalating tensions in the Middle East, with a notable increase of 24.1% on March 9th. As a result of these market movements, we observed substantial increase in price fluctuations as well as initial margin levels per contract. Looking at backtesting, the higher volatility temporarily reduced coverage levels, with backtesting results indicating breaches in margin coverage. For both index futures and precious metals futures, the coverage ratio temporarily fell below the target level of 99% in February. However, in the case of index futures, the coverage ratio has already recovered to above 99% as of April. For precious metals futures, given the persistent volatility and observed breaches, we are currently reviewing and considering enhancements to the margin calculation methodology. Let me now move on to the second topic of this quarter, which is our digital collateral management initiative. JSCC together with Mizuho, Nomura, and Digital Asset, has launched a proof of concept using the Canton network. The objective of this initiative is to explore how we can modernize collateral management using blockchain technology while maintaining the existing legal framework for JGBs. Today, collateral management still relies on limited operating hours and segmented systems, which can create inefficiencies, especially for cross-border collateral flows. Through this POC, we are testing whether the ownership transfer and book entry updates for JGBs can be processed on a distributed ledger without changing their legal status. We are also exploring the possibility of enabling near real-time and potentially 24/7 collateral movements. This could help reduce settlement timing constraints and improve overall operational efficiency, particularly for global participants. In addition, the POC allows us to identify key challenges for practical implementation, including regulatory considerations, operational workflows, and interoperability with existing infrastructure. At this stage, this is still an exploratory project, but we see it as an important step toward enhancing the flexibility and resilience of collateral management in the future. Now back to the PQD. This slide introduces JSCC's service structure. The clearing services are divided into 14 categories according to the governing regulations and product features, with each maintaining its own default funds. Please note that in this presentation, some data is presented across multiple categories, and the resources may be shared. This slide shows daily average notional value of trades cleared by asset class. Please note that the figures are calculated single-sided as detailed in the explanatory notes of the PQD. This slide shows financial resources for participant default, called Skin in the Game or SIG, and contributions from relevant exchanges and PTSs. Most of the exchange contribution is from entities in the same corporate group as JSCC, namely TSE, OSE, and TOCOM. And for stress testing, the sufficiency of the financial resources for each category was tested by prorating these shared resources according to the relevant default fund amount for each category. This slide shows the ratio of skin in the game to JSCC's capital. The left-hand graph shows the skin in the game to be used before the mutualized default fund or DF. And the right-hand graph shows the skin in the game to be used before the default fund plus alongside default fund of no defaulting participants on a pro rata basis. As described below, compensation by exchanges and PTSs are included in SIG for ETP. Skin in the game before default fund on the left ranges from 17 to 78% of shareholder equity. So, JSCC contributes relatively large amounts of shareholder equity to skin in the game compared to other major CCPs, which reflects JSCC's strong commitment to prudent and robust risk management. The ratios of skin in the game to default fund on the left range from 1 to 25% of default fund, while those on the right from 2 to 38%. This slide shows the required default fund, which covers any default-related losses that would be mutualized among non-defaulting participants. The graph on this slide shows the ratio of skin in the game and contributions from exchanges to default fund from members. On this slide, the data is listed for these graphs, and the amount of potential assessment, or so-called cash call, is also provided. As stated in the footnote, the cash call for any ATD is capped at 3 times the default fund requirement, and for OTC products, it is capped at 1 time the default fund requirement. This slide shows the largest value and mean value of the SLOIM, which is a stress risk amount exceeding initial margin deposit including add-ons. Please note that due to the PFMI quantitative disclosure definitions, the default fund shown on slide 14 is a value as at the end of the quarter, but the SLOIM on slide 17 is the largest or mean value during the past 12 months period. JSCC's default assumption is covered too, except for any listed commodity derivatives other than OSE Petroleum, which is the largest one plus the 5 smallest firms in net assets. Among all clearing service categories, ETP Index Futures option has the largest SLOIM, with a peak value of 547 billion yen. This slide shows the number of days there was a shortfall in the stress testing of free fund resources and the largest shortfall. Breaches were observed on 6 days for cash securities and 1 day for ETP Energy Tocom, and all were resolved on the next business day through the requirement for additional collateral. This slide shows the required and excess initial margin amounts. The dark blue is the house initial margin requirements and dark orange shows clients. Light blue is the excess margin for house accounts and light orange shows client accounts. The required amount of OSE listed ETP, IRS, and OTC JGB were the largest at between 2.41 and 3.01 trillion yen. Looking at the breakdown between house and clients, OSE listed ETP was driven mostly by clients. IRS was evenly split between house and clients, and OTC JGB was mostly house. This trend has remained unchanged for quite a long time. Moreover, the client's excess margin held was quite large in OSE listed ETP and IRS, which has also not changed significantly. The data used for the graph on this slide is shown on the following 2 slides. Now, this slide shows the number of breaches in IM backtesting for the past 12 months period. As noted in Q2 2025, breaches increased significantly in April due to US tariff-related market fluctuations, which caused coverage ratios to fall below target levels across multiple services. In the current quarter, the same period remains within the 12-month range, and we continue to observe elevated breach numbers. For IRS, in particular, our coverage ratios remain below targets. Coverage ratios for index futures and precious metal futures temporarily also fell below the 99% target in February. However, as mentioned earlier, the coverage ratio for index futures recovered to above 99% in April. The upper chart on this slide shows the largest breaches in the past 12 months. This test only looked at the base IM requirement without add-ons. JSCC has assessed that these breaches would have been covered, if necessary, by resources such as IM add-ons, excess IM deposit, or skin in the game, and that the default fund would have remained almost untouched. The lower chart of this slide shows the largest breaches in the past 3 months. The upper chart on this slide shows the quarterly largest value of variation margin or VM paid to JSCC, and the lower chart shows the largest value of IM calls during each quarter. For OSE listed ETP and OTC JGB, the increase was due to US tariff-related market fluctuation in Q2 2025, and the increase for OSE listed ETP in Q1 2026 was due to market fluctuations driven by multiple factors I explained earlier. Please note that while VM needed to be deposited and settled in cash, ION may be deposited in cash as well as various securities and other instruments, giving our participants some flexibility for funding. This slide and next slide show the composition of collateral used for IM deposit. On this slide, you can see that the majority of IM for ETP cash securities and for CFA regulated ETP was cash, as shown in dark orange, but some was in JGB and stocks shown in gray and yellow. Cash collateral was held at either the central bank or at selected commercial banks. The secured cash deposit at commercial banks in dark orange was held in settlement account of commercial banks, which are fully covered by the Japanese Deposit Insurance Scheme or through reverse repo transaction. On the next slide, you can see shift from cash to JGBs and the preference for commercial bank deposits over central bank deposits. Deposit of stocks are not allowed for these OTC categories. Please note that the entire amount of cash collateral for OTC JGB was held in the central bank, and for CDS and IRS, the participant or customers may select their custodian for cash collateral, i.e. a Japanese trust account, or the central bank account in the name of JSCC. The secured cash deposit at commercial banks in dark orange for CDS and IRS was held in such trust account, which is legally protected from the bankruptcy of JSCC as well as the participant. This slide separates cash deposits into those for initial margin and default fund. We are holding a total of about 6.5 trillion yen of cash collateral across all the categories. Next, this slide shows the custodians for this cash collateral, with almost 100% held in either the central bank account, settlement account covered by deposit insurance, or the trust account. This slide covers liquidity risk management. Please note JSCC's liquidity risk appetite is covered too, but this data is presented based on cover 1 in accordance with the PQD guidance. And while JSCC separately calculates and manages default fund by category for liquidity risk, JSCC calculates and manages it across categories. However, for OTC JGB, JSCC has established a separate liquidity framework using repo with clearing participants, because the transactions under this category involve large amounts of principal settlement. In the chart, you can see that the liquid financial resources significantly exceed the required amount, and no breaches were reported in the liquidity stress testing. At the time of a participant default, at least the half portion of non-cash collateral could be liquidated and applied to the settlement with survivors. However, in this data, non-cash collateral is not deducted either from JSCC's payment obligation of the estimated payment or the actual payment. Because to be conservative, we consider that it could be difficult to swiftly liquidate such collateral on the date of default. Accordingly, such collateral is not regarded as immediately available liquidity resources for the purpose of this disclosure. This slide shows the liquidity resources for the categories other than OTC JGB. Cash is deposited at the central bank shown on the first line, and secured cash deposited at commercial banks on the third line, depending on JSCC's rules. For ETP, when the clearing fund requirement exceeds 1 billion yen, half of the excess must be deposited in yen cash by each clearing participant. Therefore, the level of cash varies depending on the default fund requirement. The unsecured cash on the fourth line shows JSCC's own funds available for use as liquid financial resources following a participant default. The unsecured committed line of credit on the sixth line shows the committed liquidity available from JSCC's parent company and multiple commercial banks that have been designated as fund settlement banks, and total to more than 1.5 trillion yen. Now we will move on to Q&A session. If you have any questions, please let us know using Q&A function. We have received some questions in advance, so I will start with those first and then move on to any additional questions from you as time permits. So with that, let me start with the first question. The first question is, at JSCC, IM for ETP cash securities rose sharply, and VM for OSE listed products, including Nikkei 225 futures, reached a record high. Could you briefly explain what drove these increases and whether geopolitical factors played a role? Thank you for the question. Well, while market movements were driven by a combination of factors, there were two key drivers in our case. First, for initial margin in cash equities, we observed a sharp intraday market movement in early March, which triggered additional intraday margin calls. Second, for variation margin in OSE listed products, volatility of Nikkei 225 futures increased quite materially. In fact, the average daily price range rose by around 40% compared with the previous quarter. So overall, the increases were primarily driven by the heightened market volatility rather than any single specific event. Second question we received is, you mentioned that you are reviewing the margin framework for precious metals. Could you provide more details on what changes are being considered? Thank you. For precious metal futures, we are currently considering extending the margin period of risk, or MPOR, to 2 days. This is part of our broader review and is also being discussed in the relevant exchange committees, particularly in the context of the integration of clearing firms for listed derivatives. So this is something we are carefully reviewing from both the risk management and the governance perspective. I hope this answered to your question. With that, I would like to wrap up today's webinar. Before we wrap up, just a quick reminder. A recording of this webinar and any related materials will be shared with you on our website. If you have any further questions or feedback, feel free to reach out to us directly. Once again, thank you for joining us today. We hope you found the session informative and valuable. Thank you.